How the rich invest their money. Hi, I'm Michael. Before we start, if you are finding value in this video, please consider liking the video and subscribing to the channel. And if you want more content about psychology, money, and financial thinking, turn on the notification bell so you will never miss a new video. This helps the channel grow and allows me to continue creating high-quality educational content. Now let's begin. Today I want to talk about one of the most important skills you can learn in your life. Not just how to earn money, but how the rich invest their money. Because there is a huge difference between working for money and making money work for you. Most people spend their entire life exchanging time for income. They wake up, go to work, sell their time, and receive a salary at the end of the month. And there is nothing wrong with that. But financial freedom does not come from working harder. It comes from understanding how money behaves over time. The wealthy think about money differently. They don't just focus on how much they earn. They focus on how money grows. They focus on risk. They focus on leverage. And most importantly, they focus on long-term strategy. One of the biggest financial mistakes people make is believing that saving money alone will make them rich. Saving is important, but saving alone is not enough. If you put your money in a traditional bank account, inflation can slowly reduce the real value of your money over time. This is why wealthy people invest. They understand that money must move to grow. Think about money like a living system. If money stays still, it slowly loses power. But if money is placed in productive assets, it can generate more value over time. The goal is not simply to accumulate money. The goal is to create a system where money generates more money. This is the foundation of financial independence. Rich investors think in terms of assets, not expenses. There is a fundamental distinction between assets and liabilities. An asset is something that generates income or increases in value over time. A liability is something that costs money without producing financial return. Many people make the mistake of buying liabilities and calling them assets. Luxury cars, for example, are often not assets because they depreciate quickly. This does not mean you should never enjoy life. It means you should understand the financial consequences of your decisions. Wealth is not built by eliminating pleasure. It is built by optimizing choices. Compounding is one of the most powerful forces in finance. Many people underestimate compounding because it works slowly at the beginning. But over time, compounding can produce extraordinary results. Imagine investing a small amount of money consistently over decades. The growth may seem insignificant in the first years, but after 20 or 30 years, the accumulation can become enormous. This principle is often associated in popular culture with Albert Einstein, who is sometimes quoted saying that compound interest is the eighth wonder of the world. Whether or not he actually said this, the idea remains extremely powerful. The lesson is simple. Start early, invest consistently, and allow time to work in your favor. Risk is often misunderstood. Most people think risk means danger. But in finance, risk is more accurately described as uncertainty. The wealthy do not try to eliminate risk completely. They manage risk intelligently. They diversify. They study probabilities. They avoid emotional reactions to market movements. Research in behavioral economics shows that human beings are naturally loss-averse. This means that the emotional pain of losing money is often stronger than the emotional pleasure of gaining money. Because of this psychological bias, many people make irrational financial decisions. They sell investments during market crashes. They buy assets during hype cycles. The wealthy try to counteract this behavior by following structured investment rules. Markets are not purely mathematical systems. They are human systems. When people become optimistic, they buy more. When people become fearful, they sell more. This creates cycles of overvaluation and undervaluation. Smart investors try to remain emotionally detached from crowd behavior. They observe market sentiment without becoming controlled by it. Now let me remind you something important. If you are still watching this video, it means this topic is important for you. So please take 1 second to press the like button. Also, if you are interested in psychology, money, and financial strategy, make sure you are subscribed and that the notification bell is activated. Your support helps keep this educational content available. Let's continue. Most successful investors think in decades, not in months. Short-term thinking is one of the biggest enemies of wealth creation. Markets naturally fluctuate. Economic cycles move up and down. If you focus only on short-term performance, you will become emotionally exhausted. Great investors understand that wealth is built slowly. Warren Buffett is a famous example of long-term investment philosophy. He focused on quality businesses and held them for long periods. Charlie Munger also emphasized the importance of rational thinking and mental models. Cash flow is more important than net worth. Net worth represents accumulated value. Cash flow represents financial freedom. If you own assets that generate regular income, you gain flexibility in life. You are less dependent on a single source of earnings. Real financial independence comes from building money streams that continue even when you are not working. Your environment strongly influences your financial future. People tend to imitate the behavior of those around them. If you surround yourself with strategic thinkers, you are more likely to adopt similar financial habits. Lifestyle inflation is dangerous. When income increases, many people immediately increase their spending. They buy bigger houses, more expensive cars, more luxury consumption. But wealth is not about how much you earn. It is about how much you keep and how much you grow. Control lifestyle expansion. Technology is transforming finance. Digital markets, automation, and global investment opportunities are changing wealth creation. Smart investors observe trends but avoid speculative behavior. They analyze opportunities carefully before investing. Financial success is not the result of a single decision. It is the result of thousands of small decisions made consistently over time. Wealth is built through discipline, knowledge, emotional intelligence, and strategic thinking. The rich do not necessarily work harder. They simply learn to make better decisions. Money is not just currency. Money is a system. And if you understand how the system works, you can gain control over your financial future. Start thinking like a long-term investor. Study psychology. Study markets, study human behavior, and always remember that the most valuable investment you can make is in your own mind. Thank you for watching until the end. That tells me you are serious about learning. If you found value in this video, please like, subscribe, and activate the notification bell. Share this video with someone who wants to improve their financial thinking. Knowledge is the foundation of financial freedom. I'm Michael, and I'll see you in the next video.